Hello everyone, welcome back to the Principles of Macroeconomics. So today we come to the chapter 13, Saving, Investment, and the Financial System. So in this chapter, we will look at the first market of our concern, the financial market. Right. So the entire chapter is actually centered around this financial market or the financial system. So by the end of this chapter, you should be able to categorize an event as either saving or investment. Explain how financial intermediaries connect borrowers and savers. Analyze the relationship between bond prices and the interest rate. Explain how financial markets connect borrowers and savers. Explain the difference between the bond market and the stock market. Explain how government borrowing can lead to crowding out. Analyze how changes in demand impact equilibrium in the market for loanable funds, and the rest of the objectives are related with the market for loanable funds. So we can also call that the financial market, which channels the fund from the saver to the to the spender. All right. So let's get started. All right, let's directly jump into the topic. So the first component is financial institutions in the U.S. economy. So first thing first, what is a financial system? It is a group of institutions in the economy that help match one person's saving with another person's investment. All right, so you can consider in the economy there are two groups of people. There and it is a either or situation. So you are either of one group or the other group. Okay, so there's no third group. So for one group, they have extra money, they have extra fund after they consume. So you can call them saver. So they save money. They save a portion of their income uh, to their bank account, and they want to use it to generate some benefit. However, most of the time they don't have a channel to make full use of this fund. And on the other side of the economy, or the other part, for the other party, we call that spender. So they have some investment opportunities which can earn them a big money. Okay, so in that case, they need some they need some startup fund in order to initiate those projects. So they need money to get started. So you will find that on the one side, a group of people actually have an extra fund, so they become the supplier of the fund. And on the other side, they actually need the fund, so they become the demand for the fund. Then we get a market of the of for the fund, and then we call this kind of market as a financial market. And the financial system is actually a system that facilitates the transaction between the supplier of the fund and the demander of the fund. Okay, so we just go through this definition again. So the financial system is a group of institutions in the economy that help match one person's saving with another person's investment. So the financial system actually convert people's saving into other people's investment. And the financial institutions are the element actually facilitate the operation of the entire system. The financial institutions are the institutions through which savers can directly provide funds to borrowers. So the financial institutions is a middle person actually channel the fund from one group of people to the other. The financial markets is a place where the financial institution make all those transactions. And lastly, you can call those financial institutions as a financial intermediaries because they are not really the supplier of the fund because they don't have money to supply. And on the other side, they do not want to invest the money into the real project. So they are not the supplier, and at the same time they are not the buyer. And they are not they are also not the demand side. So they are the middle person actually facilitate the entire transaction. So that is why we call them financial intermediaries. So you can consider them as a middle person, right? Okay, so um, that is a very general. So that is a list of the concept that we will investigate in this chapter. So let's get started with the first one, the financial markets. So the financial markets is a place where the financial institutions through which savers can directly provide funds to borrowers. So the financial market is is the place where the financial institution uh, function itself. All right. So there are two typical financial markets in reality. One is a bond market. The other one is a stock market. So those two are the two major form of the financial markets. And the bond and stocks are the two most important financial instrument that facilitate this kind of a transaction. All right, so we will go through them one by one. Okay, let's put the focus on the bond market first. So what is a bond? All right, bond, it seems a little bit unfamiliar to you. However, when I tell you the definition and explain a little bit, you will find that it is not really hard to understand. All right, so the bond is a certificate of indebtedness that specifies obligations of the borrower to the buyer of the bond. Okay, it's a very complicated and abstract definition of the bond. But in reality, what is it? So simply put, the bond is an agreement between the lender and the borrower. And this kind of agreement is actually commonly seen in reality. We call that IOU. So whenever you write a contract with someone to borrow some money, or you want to lend some money to other people, then that agreement, you can consider that as a bond. All right. So the bond is a standard form of the IOU, right? So in our daily life, you borrow money from other people, you lend the money to other people. So all of them are the uh, are the uh, are the most primary form of the bond. All right. But what is the difference between between the bond and our daily borrowing? So the bond is a standardized agreement between the buyer and between the borrower and the lender. All right. So it is a standard contract. So most of the time in our daily life, when you borrow some money from other people, you do not really write a contract, right? So I want to borrow $10 from you. So normally I do not write a contract. However, bond normally is denominated in a larger amount. So normally it is associated with a kind of formal contract. And in this contract, most of the bond agreement specified three things. First is date of maturity, which is a time at which the loan will be repaid. Right? Most of the loan is not infinite. All right. So if I borrow some money from you, then I will tell you I will pay you back within 1 year. Okay. This 1 year is a term of a term to maturity. And I will also specify the specific date that I will repay you. Okay, this is a very important element, right? Okay, the second one is a rate of interest. It is a periodical payment until the date of maturity. So why do you provide the interest rate if you are a borrower? Let's just recall the concept of incentives. So if you want to ask somebody to do something, you need to provide the incentive. So the incentive can either be a benefit to it can either to be an increase in the benefit or a decrease in the cost. So the interest is is a benefit that the borrower provide to the lender in order to provide the incentive for the lender to lend the money to the borrower. All right, I know there's a quite collateral, but the rate of interest is incentive that encourage the borrowing. And lastly, the principal amount, which is the amount borrowed. Okay, so if I borrow $10 from you, so the principal amount is $10, and then at the end of the at the end of the 1 year, I will give you $11. So the $10 is a principal amount. The additional $1 is interest rate. Is interest, and the date of maturity is 1 year. Right. So all the bond contract or the bond agreement consist at least have these three elements. All right. So let's dig a little bit deeper to the bond, to the bond. So the bond have several characteristics, and based on those characteristics, we can classify different kind of bonds into different groups. Okay. So the first criteria is a term, which is a length of time until bond matures. So the term is associated with a term to maturity, or the date to maturity. So if I lend the money to you and ask you to repay me within 1 year, then the term is 1 year. Right? So based on the term, we can categorize all the bond into several groups. So the first is a short-term bond. Normally, it is denoted in the term of in months. So and the short-term bond is officially defined as a bond as a bond product that will mature within 1 year. Okay, the 1 year is a fine line between the short term and the medium term. Okay, so from 1 year to 10 year, we call that medium term, and from 10 year and above, we call that long term. There's a one unique case of the bond, or of the long-term bond, which is a perpetuities. So the perpetuities is a type of bond that will never mature. So the borrower will pay the lender interest rate forever, and the lender will not require the borrower to repay the principal amount forever. Okay, this is a very unique case and only take a tiny friction of the entire bond market. So that is not really typical. So we will not put the focus on the perpetuities. So in general, the long-term bonds are riskier than short-term bonds. The reason for that is simply because for the short-term bond, if you want to change the term of the contract, you can do it periodically. So if the bond if the bond have a term of 1 year, so every year when you issue the new bond, you have a chance to modify the term, to modify all those the content of this contract. However, for the long-term bond, whenever you set the term, you set all the requirement as an assurance, then you cannot modify everything or anything during the entire term. All right. So the long-term bond have less flexibility during the term of the maturity, and then that is why it is more riskier. So the world is changing, but you cannot change for the long-term bond. So that is why the long-term bond normally have a higher risk. The long-term bond usually pay higher interest rates in order to compensate that higher risk. So though you can consider that risk is a cost to the lender, right? The lender need to bear those risks, and this is something that they do not like. So you can consider the risk will add the cost to the lender. So that is why the lender normally require a higher interest rate in order to compensate their higher risk. All right. So the long-term bond usually have a higher interest rate than the short-term bond. Right. The second characteristic is about the risk. We call it the credit risk. It is a probability of borrower's default. All right. So sometimes the borrower may not repay the principal amount, and we call that kind of situation as a default. Right. So the probability of borrower's default is a credit risk. So this risk is try to assess the possibility of a borrower that that refuse to repay the debt at the maturity. All right. So the higher interest rate for the higher probability of default, because the possible default is a kind of a risk for the lender, because in the event of default, the lender will lose the claim, will lose the claim for all the principal amount. So the lender will lose all the money if a default happens. So in that situation, so that is why the default is considered as a cost for the lender. In order to compensate this kind of a cost or the risk, then the borrower normally require a higher interest rate for the bond with a higher default risk or the credit risk. So in general, the U.S. government bonds tends to pay low interest rate because the U.S. government is considered as an institution with no chance of a default. And then you may say, no, it is not the case. You can see that in the past 30 years, the U.S. government is always wrong on deficit. So eventually, there will be one day that the U.S. government cannot pay back their principal amount. There may be that they may happen. However, the unique property of the U.S. government bond is that the U.S. government is a issuing party for a global currency. All right. So the U.S. dollar is needed by all the country in the world. So the U.S. government can infinitely print the money in order to repay all those debt or repay all those government bonds. So in the case when the U.S. government may default in the near term, what they will do, they will start to print the U.S. dollar to pay for the debt. All right. So in other words, the U.S. government always have the resources to repay all their debt that will mature in the future. Okay, so that is why you can consider the U.S. government bond as risk-free in terms of the credit risk. So that is why they tend to pay low interest rate. And in contrast, the high yield bonds, or we call that the junk bonds, are will pay the very high interest rate. Who actually issue those high yield bonds? So normally they are the company with a lower credit rating. So they have some possibility to default. So in that case, when they issue the bond, they need to provide a higher interest rate in order to provide the incentive to the lender. Right. So the third characteristic is a tax treatment. The interest on most bonds is taxable income. So if you get some interest return or interest income from the bond, you need to pay tax or the income tax for that. However, there's one specific type of a bond that you do not need to take care of that, which is municipal bonds. It is issued by state and local government, and there's no tax for those bonds. And normally they only provide a lower interest rate, because you can consider this tax treatment is an additional benefit that the municipal bond provided to the investor to the investors. So to be comparable, if you provide more benefit in terms of the tax treatment, you can provide less interest return to the investors. So that is why municipal bonds normally bears a lower interest rate. The last one is inflation protection. So there's one special type of the treasury bond that is protected from the inflation. So it is a treasury inflation protected securities. All right. So this type of securities, we also call it TIPS. So this type of securities is actually indexed to a measure of inflation. When prices increase or prices rise, payments rise proportionally. So what does that mean? So by the end of the year, uh, the lender will give you a return, that they promised in the loan contract, and at the same time they will also adjust this return with a price change. So let me give you an example. For the TIPS bond, they agree to provide you with a real income of 1%. Okay, and then if the inflation rate during that particular year is 3%, then the interest return you will actually get is 4%, which is 1 plus 3% interest inflation. So in this sense, if the inflation rate is high, you will get a higher interest income. If the interest rate is low, if the inflation is low, your income will relatively lower. So in this way, your real income is actually protected from the change of the prices. And normally, this inflation protection is also an additional benefit provided by the government. And sometimes there's also a kind of premium that you need to pay for this kind of actual protection. Right. So let's do a very brief summary of the bond market. Okay. So for a typical bond agreement, you need to have three elements. First is a term to maturity, the time to repay. Second, the interest rate is an incentive that provided by the borrower to the lender. Third is a principal amount. So it is an amount that you borrow. And then the bond have several key characteristics. The first one is a term. All right. So based on the term, we have a short term, medium term, and a long term bond. Then we have a credit risk. It is about the possibility of the default. So a higher credit risk, the higher interest rate required. Third is a tax treatment, and fourth is inflation protection. All right. So this is a bond market, and in essence, the bond is a IOU. Whenever one party owe the other party something, you can consider that as a kind of form of the bond. All right. Now we come to the second type of the financial instrument, which is a stock. Okay, the stock is totally different from the bond. All right, the stock is not a IOU. It is a share of the ownership. Okay, the stock is a claim to partial ownership in a firm. It claims to some of the profits the firm makes. All right, so here it is not a IOU. It is a type of things that I want to have a partial ownership of you. All right, so it is a little bit difficult to understand at the beginning. So the let's just look at the partial ownership in a firm. So for the bond, in the bond market, the firm will issue a bond to the investors, and then the firm will pay an interest rate for the bond in order to attract the investors to buy this bond. right? So for the firm, they do not actually have anything to. So in the bond agreement, it have nothing to do with the ownership. All right. So in the stock market, it's different. So in the stock market, the incentive that the company provide that the firm provided that the firm provide um, to the investors is their ownership. So the firm will say that I want to give you the partial ownership of my company in exchange for some of the fund from you. All right. So the cost to the firm now is the ownership instead of the interest rate. So for the stock for the stock, the firm do not need to pay the interest rate. However, the firm need to give up some of the ownership of the firm, right? So when the investor get the stock, they do not get the periodical payment from a firm. So the payment is uncertain. The payment is depends on the operation of the firm. If the firm uh, operate operate well and it become a larger company, so it experience some dramatic growth, then you will share the profit as well as the as a appreciation of the share from that firm, right? If the firm actually go to bankruptcy, then you will not get anything from the ownership of this stock, all right? So in this sense, the stock, whenever the investor purchase the stock, you actually ride the same boat with the entire firm, all right? So you become one part. You could become you become an integral part with that firm. So the stock is a type of equity finance. It is a sale of the stock to raise the money. So it is a sale of the ownership to raise the money. So equity, you can also consider that as a net ownership of the company, the equity. Okay. The debt finance is a sale of bonds to raise the money. All right. The equity finance is you actually sacrifice some of the ownership. The debt finance is actually you sacrifice some of your cash flow. For the stock market, we have organized stock exchanges. They are the trading. Uh, they responsible of trading stock shares with the stockholders. They're the business that issue the stock receives no money. All right. So those stock exchanges, we also call that as a secondary market. So this is a market where where all different kind of investors exchange the ownership of different kind of firms. All right. So this is a marketplace for the investors, but most of the time the business or the firm that issue the stock are not the participant for the in the stock exchange. They do not actually buy or sell the bond the stock in those stock exchanges. But in some rare cases, we will see that the all those firms will directly purchase or sell the share of the company. But most of the time, it is not typical. So the vast majority of the trading volume is related with a transaction among different investors. And typical stock exchanges are is uh, New York Exchange, Nasdaq, all right, and the London Exchange, and the Shanghai, Tokyo, France. All those cities have a huge exchanges, and most of those exchanges are international exchanges. So the people from foreign country can also invest in that specific exchange. The stock prices is actually determined by the supply of and demand for the stock in these companies. So sometimes the stock price is actually divided from the actual value of the firm. So and normally the stock prices are forward looking. So when the investor invest in the stock, they not only look at the current profitability of the company, they will also try to predict the future profitability of the company. So let me give you an example of Tesla. All right. So like 3 years ago, the Tesla is do not have any profit. However, there's a huge amount of investors want to purchase a share of the Tesla. Why? Why it is the case? Because those investors can foresee the huge profit space for Tesla in the future. So instead of buying those stock in the future, they want to buy it now at a lower price and at a lower price. All right. So at a lower price. So that is why I say that the stock price is forward looking. So normally if you want to earn money, you need to do some necessary forecast about the future performance of the firm. And then based on that forecast, then you make an investment decision. The stock index is an average of a group of stock prices. For example, the Dow Jones Industrial Average, the Standard & Poor's 500 index. So the stock index normally have like two uses. One is provide a way for the ordinary investor to invest. So sometimes the ordinary investors or individual investors have a difficulty in selecting the good stock. All right, so they don't know which company to choose. So a good way to invest for those type of people, for this type of people is to invest in the stock index. So instead of invest in one specific stock, you can actually invest in the stock index. So there's an index mutual fund. So in this case, you actually diversify your risk, and also you can take advantage of the growth of the entire stock market. And the second use of the stock index is a way to evaluate the operation of the stock market. So if you find the stock index fluctuate a lot, so you may consider, okay, this financial market may be less developed. So in that case, you need to find some ways to stabilize it. So the stock index is something that the policymaker will pay attention to, in order to make some of the financial market related policies. Right. So after we talk about the two basic financial instruments, in the financial markets, then we can talk about the role of the financial intermediaries. All right. So in the stock and the bond are the two type of ways that the borrower can borrow the money, that the saver can channel the money to the investor. So for the bond, we have the borrower and lender. Lender normally is a saver, and the borrower is a person who actually need the fund. And in the stock market, it is almost the same case. So the company issue the stock is a spender who demand the fund, and then the investors in the stock market are actually the individuals with actual money, right? So those two are the financial instrument, which are the typical way that the financial market can channel the fund from one individual to another individual. Then we come to the financial intermediaries. The financial intermediaries are the financial institutions through which savers can indirectly provide funds to borrowers. So in the previous two market, the 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 uh, the savers and the borrowers are actually communicate with each other directly, right? So if they make an agreement, then they sign a contract. We call that a stock agreement or a bond agreement, or the equity finance, or the or the debt finance, right? So here the financial intermediaries are related with indirect finance. the most important are banks and mutual funds. The primary role for the banks is to take in deposit for savers and provide a small interest rate. They use these deposits to make loans to borrowers and charge a higher interest rate. The difference between the higher interest rate and the small interest rate is a profit for the banks. However, the banks also incur some of the operational cost. For example, they need to have the office space. They need to hire people to provide all those services. And then you can consider the profit of the bank is equal to the higher interest return from the loans minus the lower interest rate on the deposit and minus the operational cost and and the result is a profit of the banks. So for the banks, they do not actually own all those funds, and they do not actually use all those funds. They are the middle person. They are the bridge that actually gap those two group of people. The secondary role of the banks is to facilitate purchases of goods and services. So it will provide convenience for the transaction. For example, it can provide the checks and the debit cards to access deposit, right? So in this case, you do not need to carry the cash with you everywhere. So when you go shopping, so for example, if you want to purchase a house, it is a very large amount of transaction. It is a large amount transaction. So in this case, you don't need to carry a bag of the cash with you in order to purchase a house. So it can provide you some safety in the transaction, right? So you can simply write a check or use a debit card to make the payment. It serves as a medium of exchange. So it means that whenever you make a transaction, you can use the bank service to make the payment. So you don't need to use the cash, and you do not need to use one good in exchange for another good. Okay, so we will talk more about the medium of exchange in a later chapter, but here you can consider that the banks actually provide the service that facilitate that serve as a medium of exchange for the transactions, and also the bank can provide the service as a store of value, right? So when you hold the cash, when the household hold the cash, they cannot get any return out of it. But in contrast, if they put the money in the bank deposit, then they will earn a small amount of interest rate. So the bank deposit is a better form of the store of value than the cash because it can earn some of the interest return. Right? So the banks is a most important financial intermediaries in the financial system. So in some of the Asian country, the banks is even the only form of the financial intermediaries in the financial system. And actually, there's another type um, of the financial intermediaries, and it have an increasingly critical role in the indirect finance, and we call that mutual funds. So the mutual fund is a institution that sells shares to the public and uses the proceeds to buy a portfolio of stocks and bonds. All right. So we still consider two sides. Okay. So one side is a general public with extra money, and on the other side is all the financial product, all the uh, all the financial product or financial instrument that try to attract the money, try to get the finance. All right. So the mutual fund is an institution, actually institution purchase all those financial products like a bond or the stocks, and then divide all those financial assets into small portion, and then sell all those small portion or the small unit to the individual investors. Okay, compare with a direct investment, it have several advantages. First, it allows people with small amounts of money to diversify their holdings. It becomes less risky. Okay, so what does that mean? So let me give you an example of the Berkshire Hathaway. It is a company that is managed by the Warren Buffett. So now it have a share price of like $400,000. So each share of the Berkshire Hathaway worth $400,000. So it is a huge amount. So this amount is already adequate to purchase a new house in the US, right? So this stock is not really accessible for the small investor, right? So most of the people only invest like a several hundreds or several $1,000s in the stock market. So it is impossible for them to invest in the Berkshire Hathaway by themselves, right? However, if they invest into a mutual fund, it is another story. All right. So the mutual fund will collect a large amount of money from different small investors. So they actually pool the fund from all kind of investors. So they can not only purchase a Berkshire Hathaway and all the other companies with very high stock prices, and then they can purchase a large amount of each kind of stocks. So maybe they can purchase like a 1,000 shares of the stock 1,000 shares for each of the stocks in the Standard Poor 500. So there are 500 companies in the Standard Poor 500 index. So the mutual fund can purchase all of them with a large amount. Why it is the case? Because investor pool the money and make all those investments possible. So for the individual investors, they not only have the claim for the profit of those small those lower price shares, they can also have some claim to the high price share. Like they also have a very tiny ownership of the Berkshire Hathaway through the ownership of the mutual fund unit, right? So the second advantage is to give ordinary people access to the skills of professional money managers, right? Most of those mutual funds are managed by the professional money managers uh, who have the who have expertise in the stock investment or the bond investment. So sometimes you need to rely on the expert to make a wise investment. So if you if for an individual investor, if you want to hire those professional money managers, it will be extremely expensive. But now through the mutual fund, uh, um, you actually have the access to this kind of service with a very small amount of down payment, with a very small amount of investment. All right. So this is a mutual fund. So mutual fund enable the small individual investors to pool the fund together, and it will actually provide the risk diversification and the efficiency in the investment. There's one specific type of a mutual fund actually attract a lot of attention in recent year, which is index funds. It buy all the stocks in a stock index. It performs somewhat better on average than mutual funds. So mutual fund is managed by some professional managers, but the index fund is minimally managed by people. So index means that it actually indexed to a specific stock index. So if the index goes up, those index funds supposed to goes up. If the index goes down, and it will also happen to the index fund. So the index fund do not require a large amount of management, all right? And normally it have a lower cost than the normal mutual fund. And then when you compare the performance with a professionally managed mutual fund, you will find that on average, the index fund have a slightly better performance than the professionally mutual fund. All right. So it actually kind of impose a dilemma for the investor. Should all the investor invest in the index fund? So yes and no. So if you do not want to take any risk, then the index fund is a very is a more appropriate way to invest because you don't need to select a property manager. You don't need to select the fund managers. You just simply invest in an index. So you just follow the trend in the index. All right. So it have the lowest risk. However, if you have some faith in your capability of choosing the right person, then you may consider to invest in the mutual fund because if you find the star fund fund managers, you may get a huge amount of return, uh, a return which is much higher than the market average. All right, so it depends on the capability of choosing the people. If you are confident in your eyesight, if you are comfortable of taking some risk and comfortable of finding the right person, then go to the mutual fund. If you just want to get an easy way to invest and take advantage of the overall social economic growth, then invest in the index fund. Okay, summing up, the U.S. economy contains a large variety of financial institutions, like a bond market, stock market, banks, mutual funds, pension funds, credit unions, insurance companies. It is important to keep in mind that financial institutions all serve the same goal, they directing the resources of savers into the hands of borrowers. All right, so this is the end of the first part of the chapter 13.